Now, in the exam, you have been given, okay, this is the candle question, 8% redeemable preference shares. And you know, the balance is this simply 20,000. This is the balance as per the trial balance. And they have said that you have to look at the note number 4. Now we'll be looking at the note number 4. They say the preference shares were issued on the 1st April 20x8 at par. Now, when you see the year end, it is 30th September 20x8 and it was issued on 1st April. So April, May, June, July, August, September. So these are, you know, how many months? These are the 6 months. So 6 months, 1st April to 30th September, these are the 6 months. They are redeemable at a large premium, which gives them an effective finance cost of 12%. Now, I said that this will be given to you in the exam. So this is given. The finance assistant in Candle was uncertain how to deal with these. The dividend paid in the trial balance represents the debit side of the cash payment. Now, these are the 8% redeemable preference share. This 8% is actually the coupon rate, which is mentioned on the bond, the nominal rate. And the effective rate is 12% because the bond will be redeemed at par. That is why it is different. I explained you in the last lecture. So now, how are you going to solve this? Simply, you will be taking the opening balance, right? You will be taking the opening balance. So opening balance as per trial balance, and let's just see what was the balance. The balance was the 20,000. And okay, so it will be 20,000. Balance as per trial balance. And then you add the interest on it. 20,000 into 12% into 6 by 12, because now you have the 6 months and the rate of interest is per annum. So you will be taking 20,000 into 0.12 into 6 divided by 12. It gives you 1200. Fine. And then you have the payment. Then you have the payment. Less payment. Okay, payment is actually 20,000 into 8% into 6 by 12. So 20,000 into 0.8 multiplied by 6 divided by 12. It gives you 800. Now 20,000 minus 800 plus 1200. It gives you 20,400. Now this 20,400 is your financial liability in the non-current liability. And this 1200 is actually your finance cost in the statement of profit or loss. So this is how you're going to do in the exam. This was a very simple working, and let me just show you the opening balance, as I said, as per trial balance. And then you add the interest on effective rate less payment on coupon rate, that gives you the closing balance. This is how you're going to do. So this was the candle question. Now on the next page, you have the price well. Okay, you have the price well, and I don't see this type. Yeah, there's no financial instrument working in this question. Then you have the high wood. Do we have that? Yes, this is high wood. This is question number 353. And here you go, 8% convertible loan note. Here you go, this is 30,000. So now this is the convertible. Yes, this is what I want to show you. The 8% 30 million convertible loan note. Now this 8% is actually the coupon rate. Was issued on 1st April 20x0. Okay, 20x0. That means at the start of the year. At the start of the year. So this is complete year. Interest is payable in arrears on 31st March each year. The loan note is redeemable at par on 31st March 20x3. So 1, 2, 3 years. Or convertible into equity shares at the option of the loan note on the basis of 30 equity shares for each $100 loan note. Highwood's finance director has calculated that to issue an equivalent loan note without the conversion right would have to pay an interest rate of 10%. So the effective rate is 10%. Now, applicable discount rates are, remember now, we always take on the effective rate. So this is relevant. Examiner will be giving you the both. For 3 years, they have given us the discount factor. Now, this is the convertible. As I said, you have to do a working. So year 1, year 2, and year 3. In the year 1, 30,000 into 8%. What it gives you? Okay, 30,000 into 0.08. It gives you 2,400. Because we are doing the working in the dollar triple zero. So in the year 1, the cash flow will be 2,400. In the year 2, cash flow will be 2,400. In the year 3, cash flow will be 2,400 plus the principal amount will be paid as well. So the 30,000 will be paid in the year 3. So in the year 1, there will be only interest 2,400, year 2 2,400, and in the year 3 there will be 2,400 plus 30,000. Okay. So the discount factors is 0.91, 0.83, and 0.75. Now we need to calculate it. Okay, 2,400 into 0.91. It gives you 2,184. Then you have 2,400 into 0.83. It gives you 1,992. Then you have 2,400 plus 30,000 multiply by 0.75. It gives you 24,300. Now we will be casting it, totaling it. 1,992 plus 2,184. It gives you 2,846. Now this is your present value of debt. The total value of the bond is 30,000. And we have actually extracted the debt out of it. Because the debt is actually the two things. Debt is actually the interest for the 3 years plus the principal amount. So we have extracted the debt present value out of this 30,000. Now the convertible value full is the 30,000. We have extracted 28,476 as debt. The remaining 1,524 is actually the equity. So this equity will be recorded in the other components of equity. And this 28,476 will go in the working of the amortized cost. So 28,476, and then we're going to add interest. And interest is applied on the effective rate. Effective rate is 10%. Okay, so 28,476 multiply 10%. It gives you 2,847.6, and less payment, which is fixed 2,400, which is on the coupon rate. So now you can calculate it. 2,847.6 plus 2,847.6 minus 2,400. It gives you 2,893.6. So this is how you can calculate it. First of all, you have to split the convertible bond into debt and equity, and then the debt figure will go in the working of the amortized cost. So this is your financial liability, and this is your finance cost. So this is how you're going to do the convertibles. So this was Highwood. Hopefully you understand that. Okay, now the next question will be Keystone. Keystone. Do we have anything related to the financial instrument in this question? Yeah, unfortunately, no. So we're going to skip it. Then you have the Fresco. Fresco. Okay, let me see. Do we have anything? No. Even in this, we do not have the financial instruments. Now the Quincy. Yeah, here we go. In this Quincy question, we have this thing. I'm just going with the sequence, okay? I'm following all the final accounts question from the Kaplan kit. So 6% loan note, the value is 25,000, and the note which is given is 2. They say Quincy issued a 25 million 6% loan note on 1st October 20x1, and the year is 30th September 20x2. That means it was issued at the start of the year. Issue costs were 1 million, and these have been charged to the administrative expenses. The loan will be redeemed on 30th September at premium, which gives an effective rate of 8%. Now the coupon rate is how much? The coupon rate is 6% and effective rate is 8%. Now if you remember the working, we said the financial liability should be initially recorded at fair value, which is 25,000 minus issue cost, which gives you 1,000. So it gives you 24,000. Now you're going to add the interest, and interest is applied on the balance, 24,000 into 8%. So 24,000 into 8%. It gives you 1920, and then you less the payment which is on coupon rate. So 25,000 into 6%. This is the payment. 25,000 into 6. It gives you 1,500 less 1,500. So what is the net balance? 24,000 plus 1920 minus 1,500. It gives you 24420. So this 24420 is your financial liability in the non-current liability, and this 1920 is actually finance cost in the statement of profit or loss. So this was a simple question, Quincy, and this is how you're going to solve it in the exam. Okay, good. Then the next question is Moby. Do we have anything related to this? Yeah, we have that. Fine. So this is the question Moby 358. And here you go. This is the loan note, 40,000. And they have said that there is a note number 5. So let's just go to note number 5. The 40 million loan note was issued on 1st October 20x2. Now the year end is 30th September. That means it was issued at the start of the year. No interest will be paid on the loan. So that means there is no payment. However, it will be redeemed on 30th September for 53,240. That means currently the company is issuing the loan note. They are getting 40,000, but they will be paying 53,200, 53 lakh 240. So 40 million is what they're getting, and they will be paying 53,240. That means more than what they are getting, which gives an effective rate of 10%. So this is simple. How you're going to solve it? Quite simple. So just take the opening balance, which is 40,000, and then you have to add the interest. Interest is 40,000 into 10%. It gives you 4,000 less payment. And they said, however, no interest will be paid. So there's nil payment. So the closing balance is 44,000. So this 44,000 is actually the financial liability, your non-current liability. And this 4,000 actually the finance cost in the profit or loss. So this is how you're going to solve the question. Then again, you have one more thing. Yeah. This is toll question 359. This is the last example I'm doing. Toll 359. And then there you go. Here is 5% convertible loan note. And 50,000 is the balance, and the working is number 3. Quite interesting. We do have the convertible again on 1st April 20x3, which is the start of the year. So again we have the full year. So on 1st April 20x3, Toll issued a 5% 50 million convertible loan note at par. Interest is payable annually in arrears. The loan note is redeemable at par or convertible into equity shares. Okay, the interest on an equivalent loan note without conversion is 8%. So the coupon rate is 5%, effective rate is 8%. 50 million is the par value. The present values of 1% receivable, that means again you have been given two interest rates, but 8% is the relevant one. So how are you going to solve it? Again, how many years you have? 3 years, because they said the bond was issued on 1st April 20x3 and will be redeemed on 20x6. That means you have 3 years. And 50,000 into 5% is, so 1, 2, 3. So 50,000 into 5%. Interest every year. 50,000 into 5%. It gives you 2,500. So in the year 1, there will be 2,500 interest. In the year 2, there will be 2,500 interest. In the year 3, there will be 2,500 plus 50,000. Now you have been given the interest, the discount factor 0.93, 0.86, 0.93, 0.86, and then you have 0.79. So 2,500 into 0.93, it gives you 2,325. 2,500 into 0.86, it gives you 2,150. Then 2,500 plus 50,000 into 0.79, it gives you 4,175. So now the present value of debt will be it is 4,590. Now the full value of the convertible is 50,000. So minus 50,000. 4,050 is the equity. So this balancing figure is the equity. And as I said, now you will be taking this thing to the amortized cost working, and amortized cost working is opening balance you have calculated at 4,590. This is the debt value. Add the interest on effective rate, and effective rate is 8%. Let me just confirm it. Yes. So 4,590 into 8%. It gives you 3,676, and then you less the payment, which is fixed 2,500 on the coupon rate. That gives you the closing balance. So 4,590 plus 3,676 minus 2,500, it gives you 4,7,126. So this 4,7,126 is actually the financial liability in the non-current liability, and this 3,676 is the finance cost in the profit or loss, and this 4,050 is your equity in the other components of equity. So this is the financial instruments for you, and in every question you will see, almost every question you have the same thing. Again, in this question, this is Dune, and you will see here again you have the 5% loan note. So you can do the next question by yourself, and if you have any problem you can simply ask me.